Welcome to The Explainer. Today we're doing something a little different. We are decoding the actual architecture of modern global finance. We're going to be looking at a single company, one that quietly manages more wealth than most nations on Earth combined. We'll trace the unprecedented scale, the wild turning points, and the massive societal impact of BlackRock.
Okay, let's start with a number. $12.5 trillion. By the summer of 2025, BlackRock had reached a staggering $12.5 trillion in assets under management. This firmly cemented its status as the absolute largest asset manager in the world. Honestly, it's a number so astronomically large, it's kind of hard for the human brain to even comprehend, right? But understanding this scale, that's exactly why this matters to us. Because this single entity oversees investments that touch literally almost every conceivable corner of the global economy. So to really wrap our heads around a figure that colossal, let's look at a benchmark. Back in 2021, when their assets first crossed the $10 trillion mark, the funds they managed were roughly equivalent to 40% of the entire gross domestic product of the United States for that year. Yeah, you heard that right, 40% of the US GDP. It's a level of financial concentration that we have rarely, if ever, seen in human history. But how did we get here? To understand why this financial giant was created, we actually have to look back at its founder, Larry Fink, and a completely career-defining moment of, well, failure. During his time at First Boston, Fink and his team were these massive pioneers in the mortgage-backed securities market. But as co-head of the fixed income division, he ended up losing $90 million on a bad series of trades. Ouch. It is such a fascinating paradox that the world's largest financial empire was essentially birthed from a humiliating $90 million mistake. But that painful experience? It became the ultimate catalyst for his future, sparking an absolute obsession with developing superior risk management and super strict fiduciary practices.
Driven by the sting of that massive loss, Fink and his team decided to partner with Peter Peterson of the Blackstone Group in 1988. They launched a fixed-income asset manager, which was initially called Blackstone Financial Management. Fast forward to 1994, after experiencing some massive early success, they decided to split off and become an entirely independent company named BlackRock. And finally, on October 1, 1999, BlackRock went public, selling shares via an initial public offering on the New York Stock Exchange. Now, the story behind that 1994 split is just a classic Wall Street clash over equity. Fink really wanted to share equity with new hires to lure top talent away from the major banks. Blackstone's Stephen Schwarzman, however, absolutely refused to dilute his own stake in the venture. Because they just couldn't see eye to eye, Schwarzman let BlackRock walk away entirely. Looking back, it was a staggering miscalculation, a decision Schwarzman himself later candidly referred to as a, quote, heroic mistake. Following its IPO, BlackRock didn't just sit back. They initiated a period of explosive strategic growth. They didn't rely solely on organic momentum, Instead, they aggressively fueled their expansion through multi-billion-dollar acquisitions that completely transformed both their global footprint and the types of products they could offer.
These acquisitions are absolutely pivotal. Let's look at the big ones. First, in 2006, they purchased Merrill Lynch's investment managers division for $9.3 billion. Then came the monumental 2009 acquisition of Barclays Global Investors for $13.5 billion. Now, this didn't just add money to the pile, it fundamentally handed BlackRock the keys to the passive investing kingdom, mainly because it brought in the massive iShares ETF business. And that aggressive momentum? It's still going today. Just recently, in 2024, they made a huge $12.5 billion push into private markets by acquiring global infrastructure partners.
But here's the thing. Underpinning this entire era of insane expansion is a proprietary technology called Aladdin. It stands for Asset Liability and Debt and Derivative Investment Network. But honestly, Aladdin is far more than just a software program. Think of it as the central nervous system of global finance. It's a highly sophisticated system that keeps track of investment portfolios and meticulously monitors risk. And not just for BlackRock, but for major financial institutions all around the world. Larry Fink's early, intense obsession with risk management ultimately manifested as this massive technological powerhouse. Because of Aladdin's unmatched analytical power, Washington essentially put BlackRock on speed dial. Whenever a major financial disaster strikes, BlackRock becomes the ultimate crisis manager. Case in point,
In 2009, the U.S. Treasury retained them to price toxic assets from failing firms like Bear Stearns. Then jumped to March 2020, and the Federal Reserve chose them to manage massive corporate bond buying programs to help stabilize the economy during the COVID-19 pandemic. And, even more recently, in 2023, they were called in to literally sweep up the remains of failed institutions. They were hired to sell off $114 billion in assets from Signature Bank and Silicon Valley Bank. So you've got this dual engine running. Relentless corporate asset acquisition paired with absolute technological dominance through Aladdin, and it drove consistent compounding financial surges. To put some numbers on it, corporate revenues skyrocketed from roughly $5 billion in 2008 to over $14 billion by 2018, and then totally surpassed $20 billion by 2024. The growth trajectory has been incredibly linear and surprisingly highly resilient to broader market shocks. However, as you might guess, controlling this much global wealth naturally places BlackRock right at the absolute center of multiple fierce public controversies. When an institution manages over $12 trillion, it is fundamentally shaping markets, and that inevitably draws intense, heavy scrutiny from pretty much every end of the political and economic spectrum. One major structural criticism revolves around this concept of common ownership. This happens when competitors within the exact same market are heavily owned by the exact same powerful shareholders. Imagine one single entity owning massive stakes in both Coca-Cola and Pepsi. Because of BlackRock's immense size, it naturally manages major stakes in competing publicly traded companies across almost every industry you can think of. Researchers argue this dynamic could quietly reduce market competition and potentially inflate consumer prices. Even BlackRock itself identified common ownership as a potential business and regulatory risk in a 2023 SEC report, so it's definitely something being watched closely. Then we have the intense, highly publicized debate over environmental, social, and governance, or ESG, policies. This has triggered a massive tug-of-war. On one side, environmental activists have fiercely protested the firm, completely condemning BlackRock for remaining a major investor in fossil fuels and coal. But then, on the exact opposite side, conservative U.S. states like Florida, West Virginia, and Louisiana have aggressively divested billions of dollars away from BlackRock. They accuse the firm of pushing a woke political agenda that they claim sacrifices strict financial returns, so they're really getting it from both sides.
Geopolitically, the firm faces equally intense scrutiny over exactly where its money flows globally. In 2021, BlackRock actually became the first foreign-owned company allowed to operate a wholly owned mutual fund in China. This move immediately drew some really sharp criticism. By 2023 and 2024, U.S. congressional probes were actively investigating how index inclusions were directing funds into blacklisted Chinese entities. And the scrutiny extends to conflict zones as well. Just recently, a 2025 UN report highlighted BlackRock as a major investor in technology and military companies operating during the conflict in Gaza.
Despite all this varied and intense political pushback from literally all sides, BlackRock's trajectory just continues to evolve rapidly. They are constantly expanding their reach into brand new asset classes, relentlessly reshaping how institutional power operates in our modern era. But perhaps the most fascinating irony of all this is looking at who actually owns BlackRock. Turns out, its largest shareholders are its own institutional peers. As of June 2024, Vanguard held over 9%, BlackRock itself held about 7%, and State Street held nearly 5%. It's this incredibly tight-knit web of index fund managers, often called the Big Three, that are effectively owning each other while collectively dominating modern corporate governance.
Looking to the future, BlackRock is aggressively pushing the traditional boundaries of finance. In early 2024, they launched the remarkably successful iShares Bitcoin Trust ETF, which basically overnight became the world's largest Bitcoin fund. They are really leaning into the future by expanding into tokenized blockchain funds and pushing much deeper into private credit markets. At the exact same time, they're having to navigate really complex global events. For instance, they recently paused their efforts on a proposed Ukraine recovery fund amid the ongoing geopolitical uncertainty.
So BlackRock was born from a $90 million mistake and a profound desire to manage risk, and it has undeniably transformed into a $12.5 trillion pillar of the global financial system. As the firm continues to scale, their sheer unprecedented size leaves us to consider one absolutely critical question. What actually happens when a single institution holds this much sway over the global economy? Thank you for joining me for this explainer.